So there's a pretty big trend I've been noticing over the last while, especially when it comes to analyzing telecommunications companies and just companies with higher capex capital expenditures overall. I think investors are very confused at how these businesses are ran. They're looking at the dividends, which look like, as of right now, an inevitable dividend cut. They have a very tunnel vision, I would say, view on these businesses, their operations. And as a result, they might be passing up on some very strong companies because on the surface, if you don't do enough digging, if you don't do enough research, or if you just don't know the complexities of a business like this, it can look like the business is in very bad financial shape when in fact there is nothing wrong with it. And in this video, I'm going to go over Canada's 3 big telecoms, and I'm going to show you why, despite the financial numbers not looking good, these companies' dividends are safe. They should be able to grow the dividend at a pretty decent clip moving forward, and how they can be outstanding buys for an income portfolio, and even in the particular case of a specific telecom, a dividend growth option. So with that said, let's turn to the screen and dive right into why these telecoms dividends are not as bad as it seems, and why looking at standardized payout ratios with these companies is only going to get you in trouble. So as always, if you like the video, smash that like button, head down below, subscribe to the channel. More likes, more subscribes means we can put out more outstanding content. The number one thing I see an inexperienced investor do is they head to a website like Yahoo Finance. I'm looking at TELUS right now. They see that that's paying out 117% of its earnings, and they go, this dividend is inevitably going to be cut. And although earnings per share are accurate in some areas, this is a payout ratio that I use virtually never. The only time I'll ever use this is in something like the financial sector where cash flows are negative. For the vast majority of companies we own, we want to be looking at the free cash flow payout ratio. This is the money that the company has after all capital expenditures are paid, and is the true reliance of how much cash a company has to pay the dividend. And I'll get to why I prefer to use this over something like earnings per share in just a little bit, especially when it comes to heavy depreciation and amortization companies and heavy capex companies like telecoms. So if we go to the Y charts payout ratios in terms of the big 3, we can see that BCE, TELUS, and Rogers on a free cash flow basis are not that good either. BCE is paying out 107% of cash flows, TELUS is paying out 102%, and Rogers is paying out 73%. Now, Rogers has never been a company, typically because of its lack of dividend growth, that has ever, exceeded these types of payout ratios. But my main point to drive home here is, I told you not to look at the earnings payout ratios. Now you're looking at the free cash flow payout ratio, and it's still just as bad. It's still over 107%. So we must be thinking, okay, I've looked at both now. They're both poor, so this dividend must be either slowing dramatically in the future or it's going to get cut. And I'm here to say again that this doesn't paint the whole picture. If investing was this easy, if we could just simply look at a ratio or two and make our investment decisions based off that, absolutely everybody would be crushing the stock market. But you have to dig even deeper. Now, when you think about a telecom company, again, it is very heavy capex. It costs a lot of money to build infrastructure. Let's say 5G networks, wireline networks, running new fiber cables to new residential areas where they're building a multitude of homes over the next few years. It costs these companies a lot of money to expand. And this is a little off topic, but this is one of the number one reasons why nobody can touch the economic moat that TELUS, Rogers, and BCE have. We're talking over 92% market share, I believe it is, in the Canadian telecom industry. It's also why we pay an absolute fortune for our phone bills. But in relation to the capital expenditures, it costs these companies a lot of money to expand. Now, unless you were living under a rock during the COVID-19 pandemic, you probably realized that something went on during that pandemic that was related to interest rates. And if we look at the Canada overnight rate, we can see that during the pandemic, it absolutely collapsed. It went from 1.75% down to 0.25%. So When a company that is capital intensive sees an opportunity like this where money is virtually free, they are going to ramp up spending. They're going to ramp up capital expenditures. And over the last few years, these companies have made very, very heavy bets on their 5G infrastructure and stuff like that. So when money is cheaper, these companies tend to borrow and spend more. But now that we see, in the early part of 2022, interest rates have risen about, as fast as imaginable. I mean, if we span this out to max, there's really never been a situation, maybe in the early 2000s, that was just as bad, but rates have never risen this fast. And as a result, interest costs go up for the portion of their debt that is floating. Of course, a lot of these companies have locked down fixed rate debt. But the fact of the matter is, these companies can, to some degree, just simply turn off the taps. They don't have to expand as fast. So to give you an idea on the dividend right now and what the expected dividend would be moving forward, we can simply look at these companies from a capital expenditure perspective and kind of come to a conclusion how the dividend over the last year or so might have not been well covered. But when we go on a forward basis, these ratios are expected to drop quite a bit. So we can see that over the last 12 months, BCE has spent the most, $5.13 billion in capital expenditures. And actually, I just want to quickly go to a company like BCE's cash flow statement so that you can quickly see the element that the COVID pandemic had on these companies' spending. So we can see that CapEx over the last, in 2021 was nearly $7 billion. 2022 was 5.13. And when we go to previous years, this company never spent that much. We're looking around $4 billion. But once interest rates got cheaper, money became cheaper, these companies ramped up spending. So this is what I mean by the element that they can adjust their CapEx and spend or save in particular areas. And for the short term, they can seemingly be unable to pay the dividend, but the dividend still gets paid and dividend growth still goes on. So going back to this chart, we can see that TELUS and Rogers, they're in the mid $3 billion when it comes to capital expenditures. And we can see that cash from operations, most of these companies were still cash flow positive. Free cash flow is this cash from operations minus the capital expenditures. So we can see that BCE is still generating, over $3 billion in free cash flow. TELUS around 1.1 billion. But the issue here is the dividends make up more than that. So the reason why you see a seemingly unsustainable dividend is when we look to TELUS on a trailing 12-month basis, they've paid around $1.18 billion in dividends, but they only have free cash flow of $1.16 billion. So how are they going to pay the dividend? Well, this is a trailing basis. That is something that is very important to understand. These numbers are trailing 12-month. We need to look at the forward rates. And when we do this, and I'm going to go over all three telecoms here, we can see that the dividends are going to be very much covered if the companies hit guidance. And for the better part of the last, multiple decades, most of these companies have, for the vast majority of time, delivered on that guidance. So when we go to TELUS's Q4 report, they did give their 2023 outlook. Now, they expect operating revenue to grow 11 to 14%, adjusted EBITDA to grow 9 to 11%, capital expenditures to be approximately $2.6 billion. So if we go back to this chart, we can see that TELUS was spending $3.6 billion in CapEx. Go back to this report, they're going to tune that down by about $1 billion. So when this happens, we get the free cash flow of approximately $2 billion. And this makes perfect sense as well when we head back to the cash flow of TELUS. Last year was around $1.16 billion. They're looking to trim back CapEx about $1 billion, which is going to ultimately lead to free cash flow of around $2 billion. So once we consider this and once we consider the dividends paid, we can see that the dividend is very much covered for TELUS moving forward unless something drastic happens and it doesn't hit this guidance, which it rarely ever has. And this is exactly why you see, despite a dividend that looks unpayable, the company comes out and they deliver their dividend growth guidance through 2025. They're going to grow the dividend by mid-single digits. When we go to Rogers, it's much the same. They're looking at 4 to 7% increase in revenue, 5 to 8 in adjusted EBITDA. Rogers with capital expenditures in the 3.1 to 3.3 billion range, they're actually not trimming down, they're actually ramping up. The thing about Rogers is this is a dividend that was generally well covered regardless of this situation. If we look back to payout ratios, we can see that their cash dividend payout ratio is at around 73% and their earnings payout ratio is around 60%. Rogers is a company that really has tried to focus on growth outside of the dividend. It's been recently in times a horrible decision. It's caused the company to lag in terms of overall share growth significantly, but it is deploying its capital elsewhere, things like the Shaw acquisition, stuff like that. So their dividend payout ratio has never been historically as high as TELUS or Bell. But when we look to BCE's report as well, we see capital intensity is expected to lower to 19 to 20%. Now, BCE's definition of capital intensity, they take their operating revenue and they compare it to their capital expenditures. So they're expecting that capital expenditures will be 19 to 20% of operating revenue. And at this point in time, the company has operating revenues of around 24 billion. So even if it hits the midpoint of this guidance and we factor in, say, 2.5% growth, we're looking at operating revenues of around 24.6 billion. And if we do go, say, 19% of that, we're looking at capital expenditures of about $4.6 billion. Now, again, if we go back, this is around $600 million less than what they were spending last year. And if we go down to the total dividends paid, BCE paid around $3.448 billion in dividends and had cash flow of $3.229 billion. So if this increases to $3.6 billion, the dividend is still pretty tight when it comes to BCE, and this is typically why you don't see it grow the dividend as much as a company like TELUS, but the dividend is still covered. So after all of this, you might still be confused. How can these companies cover the dividend if the earnings per share, the most common metric used in the investment world, does not cover the dividend? Is the income statement, especially when it comes to these telecom companies, has a ton of non-cash costs on it. So why is this? Well, when a company like Bell, like TELUS, like Rogers, they buy a asset, they are allowed to depreciate it over time for a essential tax write-off. So this comes off the income statement, which impacts its net income, which essentially is the number that is used for tax purposes. This is what they're going to pay income tax on. When they buy that asset, they're allowed to depreciate it over the timeline of that asset. And to give you an actual numerical way this works, if we go to TELUS's income statement, you can see that this company has pre-tax income of $2.3 billion and net income of $1.615 billion. Now, if we go to the cash flow statement, this is where you're going to see non-cash expenses added back in. So we see net income, and throughout the course of this cash flow statement, you're going to see things like amortization expenses and depreciation expenses. These expenses do not cost the company any money in that year. They still are a cash cost, yes, but in that current year, it does not cost the company any money to depreciate or amortize an asset or an acquisition. So as a result, it is added back into the cash flow statement to give you a better picture of the actual cash that the company has on hand. And after we add all these things back in, and like I said, telecoms, very heavy capex industries are very complex. This is why you see cash statements that do have a lot of add backs. So $3.45 billion in total depreciation and amortization. So when we get down to cash from operations, this is going to be the true picture of the cash on hand that a company has. And from there, we subtract the capital expenditures to get the free cash flow, or as Warren Buffett likes to call it, the owner's earnings, the most important type of earnings in the investment world. And it gives you a true picture of the company's cash. All right, everybody, long video, just a quick break. Remember, like button, head down below, hit the subscribe button. More likes, more subscribes equals more videos just like this. Let's get back to the video. So now that we're done going over the functionality of the dividend, I want to speak on what I view is the best telecom here in Canada. And first, let's go over valuation and head back to the screen. So telecom valuations have come down in a big way, primarily because of rising rates. Obviously, these companies have a lot of debt. They do not perform well in a rising rate environment. And actually, if we head up to Y charts, they developed something. This is a brand new feature and it is pretty cool. It's called the stress test. We can see any environment that TELUS has been in and its performance in that environment. And we can pretty much see that in heavy interest rates, rising interest rate situations, this company does not do as well. We can look at during the 2022 inflation drawdown, TELUS lost around 8%, while the TSX lost 6%. During the COVID crisis, when rates were very low, it outperformed the TSX. Even much the same during the volatility, the market correction in late 2018, it outperformed. Trade crisis with China was not really relevant interest rate wise, and the company did very well. Oil price collapse, again, not really that impacted. But when we see 2013 interest rate hikes, we can see the company underperformed. We can see the real estate crisis. That was a massive volatile time. It underperformed. And obviously in the post-financial crisis environment, it did end up performing well just because it took such a large hit during the crisis, but it still underperformed the TSX. But anyways, back to valuation. TELUS is the most expensive telecom, but it is also my favorite telecom in the country. So when we look to it on a forward price to earnings basis, it is the most expensive. It's still trading at 20.6 times earnings. Canada's telecoms, outside of Rogers, historically pretty much trade at valuations relative to growth stocks. And this is primarily because of the moat that these companies have. It is insane the amount of market share they have. The amount of times the government essentially refuses to do anything about this market share, and there is very few players that could ever even penetrate the space. We saw Shaw tried until it got acquired, and Quebecer is currently trying outside of Quebec, but we are still a very long ways away from that. So again, valuations are at a premium. So I do like to value the telecom companies in terms of EBITDA because it takes away depreciation and amortization and gives kind of a truer picture of pre-tax earnings, pre-interest earnings. TELUS is middle of the pack. Rogers is the most expensive on an EV/EBITDA basis, but they're all actually relatively the same. And in terms of PEG, price to earnings to growth, TELUS is the only one that by this ratio, the very popular ratio dubbed by Peter Lynch, has undervaluation relative to its forward growth. We can see Rogers is around 3, BCE around 1, and TELUS around 0.33. Now, when we look to the estimates of these telecom companies, you'll be able to get a clearer picture as to why TELUS is arguably the most undervalued, even though it's the most expensive on a price to earnings basis, just based on its expected growth moving forward. So before seeing a setback in 2023 relative to 2022, we can see TELUS is expected to have a big rebound in earnings. This looks like a 30+% growth rate in earnings, and it's also expected to grow revenue in the mid-single digits. You just won't find this with the other two telecoms. When we look to BCE, it looks to be in the low single digits in 2024 before rebounding to a little bit of high single digit growth. But in terms of revenue, it is not expected to grow as fast, low single digit revenue growth. And when we look to Rogers as well, it's expected to earn $4.26 in 2023, and that number is expected to only jump around 25-30 cents annually, while revenue is virtually expected to stay flat over the next 3 years. So although we're paying more for TELUS right now, this is primarily due to the expected growth rates from the companies moving forward. And this, I've mentioned this before, is largely in part due to the fact that TELUS is just diversified in industries that are higher margin, more profitable, and just faster growth. This is exactly why they've guided to, 11 to 14% growth over the next few years, while TELUS and Rogers are mostly in the low to mid single digit range. So when we look at the historical numbers, TELUS has been the fastest growing telecom by a mile over the last half decade. We can see that revenue has grown 29%, EBITDA by 30%, and dividend has grown by 39%. BCE and Rogers don't even touch any of these metrics by a mile. We can see revenue growth, 3%, 1%, EBITDA 7 and 5, and the dividend 28 and 4. Although this is Rogers' dividend policy, they just don't really grow the dividend. That's just kind of their business practice. So I wouldn't expect to see much growth here. But in terms of actual numbers, TELUS is thumping them over the last half decade. And when we look to expected estimates for next year in terms of earnings and EBITDA, we can see that TELUS is the only telecom expected to grow at a double-digit pace. Rogers and Bell are in the mid to low single-digit range. So I've always been a fan of TELUS. It's one of the longest standing holdings in my account. It would be the one that I would be buying today. However, I don't blame those who look to BCE primarily for the market share, the blue chip status, the fact that it just has so much exposure across Canada and it pays a higher yield. I do understand that some people will be looking for higher yields. Now, I did show you in the free cash flow CAPEX section of it that BCE's dividend is relatively tight, even if they scale that CAPEX back. A company like Rogers and a company like TELUS has a lot more room if they hit their next year's guidance. So that's something to keep in mind. I do not think BCE is going to cut the dividend by any means, but we could see slower growth, especially if interest rates remain higher. Everybody, if you like in-depth analysis videos like this, smash that like button, subscribe to the channel, but most importantly, drop a comment and let me know. If you want quicker, more snapshot-like videos where I just quickly go over companies, that's absolutely fine by me. If you like these long, in-depth analysis videos where I dig into the numbers, you just gotta let me know so I know what to make. But that's it for this video. Drop a comment down below. Let me know what telecom company you own, what one you're planning to buy, and if this video maybe changed your perspective on Canadian telecoms and what ones you've been looking into. And again, we'll see you next time.